The question, is it too late to buy a Bitcoin ETF, usually appears after Bitcoin has already attracted attention, institutional capital, and strong headlines. But the question itself can be misleading. An asset trading above its historical price is not automatically too late to buy. At the same time, a powerful long-term story does not automatically make the current price attractive. Those are two different issues. The honest answer depends on four factors. First, whether Bitcoin adoption can continue from today's level. Second, whether the current valuation already assumes too much future demand. Third, whether the investor can tolerate the extreme volatility that remains part of Bitcoin ownership. And fourth, whether the position is small enough to survive a major decline without damaging the rest of the portfolio. In 2026, Bitcoin ETFs are no longer small experimental products. They have attracted billions of dollars, deep trading liquidity, and participation from investors who previously avoided cryptocurrency because of wallets, exchanges, and private key management. But market maturity did not eliminate risk. Bitcoin can still experience severe drawdowns, even while the ETF structure continues operating normally. That creates the central tension of this video. Bitcoin may be more accessible and institutionally accepted than ever before. It may also be priced with far more optimism than during its earlier years. The objective is not to predict the next Bitcoin price move. It is to decide whether buying today would represent a disciplined long-term allocation or an emotional reaction to fear of missing out. To answer that, we first need to understand what a spot Bitcoin ETF actually gives the investor and what it does not. When you buy a spot Bitcoin exchange-traded product, you generally do not receive Bitcoin in a personal wallet. You purchase shares of a trust or fund through a brokerage account. That trust holds Bitcoin through one or more institutional custodians, and the shares are designed to follow the value of the Bitcoin owned by the vehicle. This structure removes several operational challenges. You do not need to create a wallet. You do not need to protect a seed phrase. You do not need to send cryptocurrency across a blockchain. And you can often hold the product beside stocks, bonds, and other funds inside the same account. That convenience is one of the strongest reasons Bitcoin ETFs have attracted traditional investors. But the convenience comes with limits. An ETF shareholder normally cannot withdraw the underlying Bitcoin. The shares cannot be sent directly to another wallet. They cannot be used for on-chain transactions. And the investor depends on several institutions: the brokerage, fund sponsor, trust structure, and custodian. Direct Bitcoin ownership offers more control. It allows 24-hour transferability and the possibility of self-custody, but it also creates personal security risk. If private keys are lost or compromised, the loss may be permanent. Neither method is universally safer. The risks are simply located in different places. The ETF solves much of the operational problem. It does not solve the investment problem. Bitcoin can still decline sharply, the fund can still trade at a loss, and easier access can sometimes encourage investors to buy a position larger than they would have purchased through a more complicated direct ownership process. Now that the structure is clear, we can examine the 2026 market itself, where enormous ETF adoption exists beside equally enormous volatility. The 2026 Bitcoin ETF market demonstrates two realities at the same time. The first is that institutional adoption has become substantial. One representative United States spot Bitcoin product held approximately $46.9 billion in net assets near the end of July 2026. It also traded approximately 39 million shares per day on average, with a very narrow median bid-ask spread. Those numbers indicate a mature and highly liquid investment vehicle. The second reality is that the underlying asset remains extremely volatile. The same representative product had traded across a very wide 52-week range and had produced a significantly negative year-to-date return by late July 2026. That combination is important. Deep liquidity makes it easier to buy and sell Bitcoin exposure. It does not make Bitcoin easier to value. A narrow trading spread reduces transaction friction. It does not reduce the possibility of a 40 or 50% drawdown. And the fund holding tens of billions of dollars does not create a guaranteed price floor. This is one reason the phrase institutional adoption should be used carefully. Institutions can buy, they can also sell. ETF flows can support demand during periods of optimism and accelerate selling pressure when investors reduce exposure. The product structure is functioning. The investment outcome remains uncertain. For a beginner, this distinction prevents a common mistake, assuming that because the ETF is regulated, liquid, and professionally custodied, the underlying asset has become conservative. It has not. A Bitcoin ETF is a traditional wrapper around a non-traditional and highly volatile asset. That means the question is not whether the ETF market is legitimate. It is whether Bitcoin's future adoption can justify buying at the current level. And to make that judgment, investors must escape one of the most common psychological traps, focusing only on the price they missed. Many investors decide an opportunity is gone because the asset used to trade at a much lower price. That feeling is understandable. It is also not a complete investment analysis. The fact that Bitcoin was cheaper in the past does not tell us what return it may produce from today. A stock can rise for years while the underlying business continues creating value. Another asset can fall sharply and still remain unattractive because its thesis is deteriorating. Price alone does not answer the valuation question. The backward-looking investor asks, "Why did I not buy earlier?" The forward-looking investor asks, "What must happen from here for this investment to work?" That second question is more useful. For Bitcoin, future returns depend on factors such as adoption, regulation, liquidity, network security, and continued demand for a scarce monetary asset. If those drivers expand significantly, a higher historical price may not mean the thesis is finished. But if the current price already assumes near-perfect adoption, the future return may be limited even if Bitcoin continues succeeding. The opposite mistake is assuming that a decline automatically creates value. A lower price may represent an opportunity. It may also reflect weaker demand, tighter liquidity, regulatory pressure, or a damaged narrative. Cheaper is not always better. More expensive is not always too late. The correct comparison is between today's price and the reasonable range of future outcomes. This is harder with Bitcoin because there are no corporate earnings, dividends, or traditional cash flows to anchor the analysis. There's no normal PE ratio to compare with historical averages. That means investors must understand the non-traditional drivers that create Bitcoin's value. So before deciding whether the current price is attractive, we need to examine how Bitcoin can be valued at all. Bitcoin cannot be analyzed like a normal company. A company may produce revenue, profit, free cash flow, and dividends. Those cash flows can be estimated and discounted to calculate a range of intrinsic values. Bitcoin does not produce corporate earnings. It does not own factories, sell subscriptions, or distribute a dividend. Its value depends primarily on scarcity, adoption, liquidity, and confidence. Scarcity begins with Bitcoin's programmed maximum supply of 21 million coins. New issuance declines over time, which limits the amount of additional Bitcoin entering the market. But scarcity alone is not enough. An asset can be scarce and still have little value if few people want it. Demand is therefore the second part of the thesis. Bitcoin must continue attracting individuals, advisors, institutions, corporations, or other large pools of capital. Liquidity is the third factor. When financial conditions are loose and investors have more capital available for risky assets, Bitcoin can benefit. When liquidity contracts, leverage falls, and risk appetite disappears, the price can decline rapidly. Confidence is the fourth factor. Investors must believe that the network will remain secure, regulations will permit continued access, and Bitcoin will maintain its role as a credible monetary asset. These variables create a valuation framework, but not a precise number. There is no fundamental floor based on future cash flow. That is why Bitcoin can trade much higher or lower than expected without violating a traditional earnings model. The investor is purchasing a networked monetary asset, whose value depends on continued collective adoption. That makes the thesis powerful but difficult to measure. The bull case argues that adoption is still incomplete and that ETFs have only begun opening Bitcoin to traditional capital. The bear case argues that widespread access may already have captured much of the obvious demand. We will begin with the strongest reason it may not be too late. The strongest bull case is not that Bitcoin looks cheap, it is that long-term adoption may still be incomplete. Spot ETFs have reduced one of Bitcoin's largest barriers: operational complexity. Investors can now purchase exposure through a familiar brokerage account without managing private keys or relying on a retail cryptocurrency exchange. Financial advisors can include Bitcoin in traditional portfolio systems. Institutional investors can access regulated products with professional custody, reporting, and substantial liquidity. That creates a broader potential investor base. The ETF market structure has also improved. In-kind creation and redemption mechanisms can reduce operational friction by allowing authorized participants to exchange Bitcoin directly for fund shares, rather than relying on only cash transactions. This does not guarantee better returns, but it can help the product operate more efficiently. The fixed supply remains another central argument. If the number of potential investors continues growing while Bitcoin's long-term supply remains limited, increased demand could create upward price pressure. Supporters also believe Bitcoin may become a more established alternative monetary asset or store of value. Under that scenario, the total addressable market could be much larger than the current ETF asset base. But the bull case requires discipline. It does not mean the price will rise smoothly. Bitcoin could experience multiple severe declines while long-term adoption continues. It also does not mean every purchase price is reasonable. A strong thesis can be temporarily overvalued. The real bullish argument is that Bitcoin's market may still be transitioning from a specialized crypto asset toward a more widely owned financial asset. The ETF is one bridge supporting that transition. But bridges work in both directions. The same accessibility that allows new capital to enter also allows capital to leave quickly. And Bitcoin's lack of cash flow creates a bear case that should not be minimized. The strongest bear case begins with the fact that Bitcoin produces no traditional cash flow. There are no earnings supporting the valuation. There is no dividend rewarding investors while they wait. The price depends on future demand. That does not make Bitcoin worthless, but it makes the investment highly sensitive to confidence. If investors become less willing to allocate capital, the price can fall without any change in the number of Bitcoin available. Volatility remains another major risk. A large ETF market does not prevent deep drawdowns. An investor who purchases after a strong rally may experience a severe loss before the long-term thesis has time to develop. Custody concentration should also be considered. Large amounts of ETF-held Bitcoin may depend on a relatively small number of major custodians. A serious operational, cybersecurity, or legal problem involving one of those institutions could damage confidence across multiple funds. Regulatory risk has not disappeared either. Rules involving custody, taxation, trading, retirement accounts, or financial advisor access can change. Bitcoin may remain legal while becoming more expensive or difficult for certain investors to hold. Portfolio risk is the final issue. Bitcoin can be a legitimate asset and still be a terrible position when it becomes too large. An investor may begin with a small speculative allocation. After appreciation, that position may quietly become one of the largest risks in the portfolio. A major decline then affects retirement plans, emergency reserves, or the ability to remain invested in stocks and bonds. Popularity does not create a guaranteed price floor. ETF adoption does not eliminate selling pressure, and scarcity does not guarantee that demand will grow forever. The bull case deserves attention. The bear case deserves equal weight. One popular argument attempts to resolve the uncertainty through Bitcoin's historical cycle, but the 4-year pattern may be less reliable than it appears. Bitcoin investors often refer to a repeating 4-year cycle, The basic pattern begins with a halving event that reduces new supply. Attention increases, the price rises, speculation accelerates, then a major drawdown follows. This pattern has appeared several times, which makes it tempting to treat the cycle as a predictable rule. But a few historical examples do not create a law of finance. The Bitcoin market of 2026 is different from earlier cycles. Spot ETFs provide access to institutional and advisory capital. The market is larger and more liquid. Professional derivatives, custody systems, and financial products are more developed. Global macroeconomic conditions may also play a larger role. Interest rates, dollar liquidity, and risk appetite can influence Bitcoin even when the halving schedule remains unchanged. ETF flows may amplify or weaken traditional cycle behavior. Large inflows can support demand. Large outflows can create selling pressure unrelated to mining supply. Regulation can also alter market structure. A favorable rule can expand access. A restrictive rule can reduce participation. This does not mean the halving is irrelevant. Lower new issuance can still affect the balance between supply and demand, but it is only one variable. An investor who buys solely because a chart suggests that Bitcoin should rise during a certain year is not following a complete thesis. Historical cycles are useful context. They are not a guaranteed buy signal. This matters because many investors waiting for the perfect phase of the cycle either buy after the move has already occurred or remain in cash while the price continues rising. Rather than pretending the next market path is known, a better approach is to choose an investment process that can survive several possible outcomes. Before comparing those entry strategies, this is the right point to reinforce the larger purpose of the channel. If you prefer Bitcoin analysis without million-dollar price targets, perfect cycle predictions, or fear of missing out marketing, subscribe to Boring Money Wins. The purpose of this video is not to convince every investor to buy a Bitcoin ETF. It is to replace the emotional question, "Am I too late?" with a more useful framework. Do you understand the thesis? Can adoption continue? What could cause demand to weaken? How much volatility can you tolerate? And what position size would allow you to remain disciplined during a major decline? If this approach is helping you evaluate Bitcoin as part of a portfolio rather than as a lottery ticket, click the like button. That helps YouTube recommend the video to more investors looking for crypto analysis without unrealistic promises. The most important question is not whether Bitcoin can rise. It clearly can. The important question is whether you can hold the position through the risks required to earn that potential return. A successful investment plan must survive both market conditions and investor behavior. That is why the next decision is not simply buy or avoid. An investor may buy immediately, build the position gradually, or wait for clearer conditions. Each strategy solves a different psychological problem and creates a different type of risk. The market may rise immediately after the purchase, it may fall first, or it may move sideways for an extended period. No entry method wins in every possible path, so instead of trying to predict the next move, the investor should choose the process that produces the most sustainable behavior. That brings us to the practical question: buy now, scale in, or wait? A lump sum purchase creates immediate exposure. If Bitcoin rises soon after the investment, the full position participates. It also creates the greatest entry point risk. If the price falls sharply the next week, the investor experiences the entire decline at once. Dollar cost averaging divides the purchase across several dates. This reduces the emotional pressure of choosing one perfect entry point. It does not eliminate investment risk. If Bitcoin continues rising, later purchases occur at higher prices. If Bitcoin falls, the investor continues buying during the decline and lowers the average entry cost. Waiting for a lower price preserves cash. It may produce a better entry if the market declines, but the decline may never arrive. Some investors wait for a 10% drop. When it comes, they expect 20%, then 30%. Eventually, the price recovers and they still have no position. The best strategy depends partly on which regret the investor can manage. Would buying before a decline cause panic? Would missing another rally cause emotional chasing? An investor with strong conviction, a long horizon, and a deliberately small allocation may prefer immediate exposure. An investor who believes in the thesis but feels uncertain about the current price may prefer scaling in. An investor who does not understand the thesis or cannot tolerate the volatility should not use dollar cost averaging as a way to avoid making a real decision. No schedule can transform a weak thesis into a good investment. The process should be chosen before the next major price move. That creates discipline when headlines become emotional. After deciding how to enter, the investor still needs to select the actual product. Bitcoin ETFs may hold the same underlying asset, but fees, liquidity, tracking, and custody can produce meaningful differences. The first step is deciding that Bitcoin belongs in the portfolio. Only then should the investor compare ETFs. The sponsor fee is the most visible difference. It is charged annually and gradually reduces the value of the fund. A lower fee is generally preferable when all other factors are equal, but all other factors are not always equal. Liquidity affects how easily shares can be traded. A large product with high volume and a deep order book may provide more consistent execution. The bid-ask spread represents the immediate cost of entering and exiting. A narrow spread may matter more than a very small difference in annual fees for someone making a large transaction. Tracking is another consideration. The fund's return should remain close to the Bitcoin benchmark after expenses. Cash balances, operational costs, and fund mechanics may create small differences. Custody deserves careful attention. Who stores the underlying Bitcoin? Does the product rely on one custodian or several? What protections, insurance arrangements, and operational procedures are described in the prospectus? Fund structure also matters. Creation and redemption methods can affect tax efficiency, liquidity, and how closely the market price follows the value of the underlying Bitcoin. A representative large spot product in July 2026 had approximately $46.9 billion in assets, a sponsor fee of 0.25%, and a median spread near 0.03%. Those numbers illustrate what a mature product may look like. They do not mean the largest fund is automatically the best choice for everyone. The lowest fee is not always the best execution. The largest fund is not automatically free of risk. Product selection can improve implementation. It cannot repair the decision to hold too much Bitcoin. That is why position size should be determined before the final ETF is chosen. The order of decisions matters. First, determine how much of the total portfolio should be exposed to crypto. Next, decide how much of that crypto allocation should be Bitcoin. Only then select the specific ETF. Many investors reverse this process. They become excited about one fund, buy it, and only later realize that Bitcoin represents too much of their overall wealth. Position size is the first risk control. Imagine Bitcoin falls 50%. A small position may create an uncomfortable but manageable portfolio decline. A very large position can damage long-term financial goals and pressure the investor to sell at the worst moment. The allocation should consider the investor's time horizon. Money needed during the next few years should not depend on Bitcoin recovering from a major drawdown. Emergency savings should remain separate. High-interest debt should not be ignored to fund a speculative allocation. The position should also include a rebalancing rule. If Bitcoin rises and becomes much larger than the target allocation, part of the position may be reduced. If it declines, the investor must decide in advance whether to restore the target or allow the position to shrink. These rules prevent emotions from rewriting the plan. The investor should also ask a direct question. Can I tolerate a 50% decline without selling, losing sleep, or abandoning the rest of my portfolio? If the answer is no, the position is probably too large. A good ETF cannot fix an oversized allocation. A low fee cannot compensate for behavior that turns volatility into a permanent loss. Once the size is controlled, several different decisions can be rational. The investor may buy now, scale in, keep Bitcoin on a watch list, or avoid it entirely. The correct answer depends on the individual framework, not the popularity of the asset. The first rational decision is to buy now. This may fit an investor who understands the thesis, accepts severe volatility, has a long time horizon, and is using a controlled position size. The second decision is to scale in. This may fit someone with positive long-term conviction but uncertainty about the current entry point. The purchases should follow a written schedule rather than changing every time the price moves. The third decision is to keep the ETF on a watch list. An investor may understand Bitcoin but believe the current price, market conditions, or personal finances do not justify a purchase yet. A watch list should include specific conditions that would cause a decision to be reconsidered. Otherwise, waiting becomes permanent indecision. The fourth decision is to avoid Bitcoin entirely. That can be rational for someone who does not believe in the monetary adoption thesis, cannot tolerate the volatility, or already have substantial indirect crypto exposure. No investor is required to own Bitcoin. Fear of missing out is not a portfolio requirement. Doing nothing can be a professional decision when the investor does not understand the asset or the risk does not match the financial plan. A simple decision tree can help. Do you understand what creates Bitcoin's value? If not, avoid the position until the thesis becomes clear. Do you accept the possibility of a severe drawdown? If not, remain on the watch list or avoid it. If the thesis is understood and the drawdown is acceptable, the remaining choice is whether to buy immediately or build the allocation gradually. This framework prevents the headline to decide the action. It also prepares us for the honest final answer. Bitcoin ETFs may not be too late, but they can still be too expensive, too volatile, or too large for a particular investor. So, is it too late to buy Bitcoin ETFs in 2026? Not necessarily. It may not be too late if Bitcoin adoption continues expanding, the investor has a long time horizon, major drawdowns are accepted, and the position is carefully controlled. But not too late does not mean automatically attractive. Bitcoin may be too expensive when the current price assumes near perfect future adoption. It may be too volatile when a large decline would force the investor to sell. And it may be too large when crypto begins dominating a portfolio that was supposed to fund retirement, housing, or other essential goals. The strongest case for buying is not that Bitcoin will rise next month. It is that ETF access, limited supply, and broader financial adoption may support long-term demand. The strongest case against buying is that Bitcoin has no value. It is that an asset without cash flow can experience enormous valuation changes when demand and confidence shift. The rational framework combines four elements: a thesis the investor understands, a time horizon long enough for the thesis to develop, a position small enough to survive the volatility, and an entry process that does not depend on predicting the next price move. An investor following that framework may buy today. Another may scale in. Another may wait. Another may avoid Bitcoin completely. All four decisions can be correct when they match the investor's financial reality. Bitcoin ETFs may still have meaningful long-term potential. They do not deserve unlimited portfolio space. Understand the thesis. Choose the size. Select the product. Follow the plan. Ignore the hype and let boring money win.